Welcome back to Stock School Daily.
Someone knows something.
That's the heart of it. 45.7 million shares. And you have to remember, for every seller, there has to be a buyer, right?
Right. It's a two-way transaction.
Exactly. So when you have that much selling, millions of shares getting dumped, buyers usually get spooked. They step back.
They'll say, whoa, I'm not buying at 93 cents if everyone's panicking. I'll wait till it hits 80.
Or 70 or 60. They lower their bids. That's what causes the price to crash.
But that did not happen here. The price was glued to 93 cents.
Which brings us to this key idea, absorption.
Okay, let's break that down. Absorption.
Think of it like a fire hose of sellers blasting shares into the market. Normally, that would just flood everything. The price would collapse.
Yeah, of course.
But in this case, it was like someone showed up with a giant industrial tanker truck and just sucked up every single drop of water the second it came out of the hose.
So the water level, the price never changed.
Precisely. The fact that 45 million shares were sold and the price held firm means a massive buyer, or a group of buyers, built a brick wall at 0.93 cents. They were effectively saying, go ahead, sell us everything you've got at this price, we'll take it all.
That is incredibly aggressive. That's not just casual buying, that's a statement.
It's a line in the sand. It tells you that whoever's in the buy side believes 93 cents is the absolute bottom.
So who is it? I mean, who wakes up and decides to buy 45 million shares of a stock that's been crushed?
It's probably not your average retail investor.
Yeah.
And this is where the data gets really interesting. The source points to a specific metric, off-exchange volume. On January 22nd, 48.61% of that massive volume happened off-exchange.
Almost half.
Nearly half of that skyscraper day happened in the dark. That's our biggest clue. This wasn't retail panic. This strongly suggests institutional accumulation. A whale, or whales, wanted as many shares as possible at 93 cents without spiking the price.
Yet. That's the key word, isn't it? Yet.
Right. You don't make a move like that just to break even. You do it because you think it's about to move. You anticipate news.
Okay, so we've got the buyers, the whales, and the dark pools. But what about the other side of the trade? The sellers. Someone is selling those 45 million shares.
And this is where the setup gets potentially explosive. We need to talk about the short squeeze.
A term everyone thinks they know since the whole GameStop thing, but let's break it down for this specific case. Who are the shorts here?
So short sellers are betting the stock will go down. They borrow shares, they sell them, and they hope to buy them back later at a much lower price.
They need to return what they borrowed.
Exactly. Their goal is to profit from the price drop. They want it to go to zero, ideally.
But here's the kicker from the source data. On that same day, the short volume was 50.64%. That's over 20 million shares sold short.
In a single day. That is an incredible amount of negative bets being placed on the company.
But there's a trap.
The huge trap. We just established that there's a buyer's wall at 93 cents. The price refuses to drop. So all those people who just shorted the stock are now stuck.
They're betting on a floor that just won't break.
Precisely. And that creates a powder keg. The source calls it the shorts being trapped. If the stock price moves up even a tiny bit, say to $1 or $1.10,
all those short positions are suddenly losing money. They're underwater.
and when shorts start losing money, they panic. To close their position and stop the bleeding, they are forced to do one thing.
They have to buy the stock back,
They have to buy. And their forced buying adds more demand,
which pushes the price up even more.
which puts even more shorts underwater, who then also have to panic and buy.
It's a feedback loop,
Yep.
the cascade.
It's a vertical price explosion. That's the anatomy of a short squeeze. And the trigger for all of this could just be a tiny little nudge upwards. The tension is already there.
It feels like a coiled spring. You have the whales holding the floor down here, and the shorts are up here, jumping on it, trying to break it.
And that brings us to the technical outlook, because the chart itself is suggesting the sellers are just done. The source points to something called a percent stacked area chart.
Okay, that sounds pretty technical in plain English.
The takeaway is simple. It shows that the long, ugly, multi-year decline has finally flattened out. The selling has stopped. In trading, we call that capitulation.
Capitulation, as in surrender.
Exactly. Everyone who wanted to sell in a panic has already sold. The sellers are exhausted.
And if the sellers are gone and these huge buyers have just stepped in,
The path of least resistance is up. It's almost just physics at that point. Which leads to the most important part for anyone watching this, the risk versus reward.
let's run the numbers on that because the source makes a really compelling case for what they call asymmetric returns.
Right. Let's think about the risk, the downside. The stock is at 93 cents. The all-time low is around 90 cents. So if you're wrong, your maximum loss is maybe a few pennies per share.
You're already in the basement. There's not much further to fall.
Exactly. Now look at the reward, the upside. If this squeeze triggers, or if good news is coming, a reversal could easily see the stock go back to $3, maybe even $5.
Which doesn't sound like a lot, but in percentage terms.
It's gigantic. A move from under $1 to $3 is a 200% gain. To $5 is nearly 500%.
So you're risking what? Maybe 5% to potentially gain 500%.
That is asymmetry. And that is what smart money looks for. They hunt for bets where the potential payout is orders of magnitude larger than the initial risk.
It's like a coin flip, where if you lose $1, but if you win, you get 100. You take that bet.
In theory, yes. The source is essentially arguing that the bears got greedy. They kept shorting it all the way to the bottom.
Ooh, picking up pennies in front of a steamroller.
And that steamroller just might be the 45 million shares of buying that showed up on January 22nd.
Okay, let's pull this all together. We have a massive, weird volume spike.
We have absorption defending the price at a key level.
Almost half the trading happened in dark pools, which points to institutions accumulating shares.
And you have a massive number of short sellers who are trapped, creating the fuel for a potential squeeze.
The source gives this a strong watch rating. It's basically saying, pay very close attention.
There's an old saying in trading, volume precedes price. The big move in volume almost always happens before the big move in price.
It's the tremor before the earthquake. I like that. It's something you can actually watch for.
And that 93-cent level is the key.
Yeah.
As long as the price holds there, the thesis is intact. If it breaks below, maybe the whales were wrong.
But it's hard to believe that 45 million shares get it wrong. Someone put a massive amount of capital on the line that day. They weren't just guessing.
No. When you see that kind of money move, especially in the dark, it implies they have information that the rest of us don't.
In my opinion,
So, on January 22nd, 2026, statistically abnormal happened with Beyond Meat. You've got this massive volume spike. We're talking 45.7 million shares traded. That's a huge signal that someone somewhere knows something big is coming. First, let's talk about absorption. Now, usually when you see a skyscraper volume like that, it means massive selling pressure is about to crash the price. But get this, the stock barely moved. It held firm at 93 cents. That tells you a huge buyer is right there just soaking up every single share that comes on the market. Second, the smart money is trying to be sneaky. Almost half of all that trading, it happened in what are called dark pools, private exchanges, off the public radar. This looks a lot like big institutional whales are quietly buying up huge positions without tipping anyone off. And finally, this is just a classic short squeeze setup. Over 20 million shares were shorted. That's people betting the stock will fall. But now they're trapped. A tiny price bump, we're talking just 10 or 15 cents, and they could be forced to buy back in a panic. And that could trigger a vertical explosion with potential for 300 to 500% upside, maybe hitting $3, $4, even $5. So, with the bears totally exhausted and the shorts way over their skis, that 93-cent level is looking like a serious launch pad. Just remember, in this game, volume always leads price.
Thanks for watching. If you found this helpful, hit that like button and subscribe for more.